We now take you live to Washington, D.C., where Federal Reserve Chair Jerome Powell is testifying before the House Financial Services Committee.
And I would say we take it very seriously. We have quite elaborate and serious and strict provisions around staff access to information, serious protections for confidential information. We have background checks. We have annual training. We have many of those things. I don't know that we've made any fundamental changes, but we're certainly, sorry, very sorry to see something like this having taken place. And we're certainly looking at the protections we have in place.
Great. Well, I have another question, and we'll just submit as a QFR, but I know the chairman said you've got a heart out, so I'll go ahead and yield back my time. Thank you, Mr. Chairman.
Thank you. Senator Van Hollen.
Thank you, Mr. Chairman and Chairman Powell. Good to see you. I want to start by acknowledging the continued uptake of the FedNow real payment system. I know I've raised the development and rollout of that system with you in many, many hearings over many years. We're now about 2 years after launch. I want to continue to work with you and your colleagues to encourage expanded adoption of the capability and capacity so that customers have real-time access to their money. So I just ask that we continue to work on that together. You agree?
I do.
I thought you might. Thank you. So I want to ask you about the student loan situation in the country. And you've talked about this in the past, and you've talked about how it can be a drag on the economy, especially when it gets to be very high in terms of balances that cannot be paid. According to the New York Fed, student grew by $16 billion to reach $1.63 trillion in the first quarter of this year. Data shows an uptick in the student loan delinquency rate overall, the age of delinquent borrowers, and the number of newly delinquent borrowers. The Department of Education, meanwhile, restarted debt collection activities last month, and starting in July, nearly 2 million borrowers could see their wages being garnished. Meanwhile, here in the Senate, President Trump and our Republican senators are working to pass this piece of legislation that would limit affordable loan repayment options and make it harder for borrowers to responsibly repay their debt and get back on a path toward financial health. So, Mr. Chairman, you said before in your testimonies that student loan debt can negatively impact borrowers' ability to fully participate in our economy, and that it can weigh down on the economy overall. Is that still your view?
Yes, it is.
And could you just share your assessment, just from a factual perspective, about how this problem seems to be growing at this point in time, and what would happen if we allow all of these borrowers to default?
So the point I was making, I try hard not to comment on things that aren't Fed policy, but I broke that rule in this case many years ago, so I'll just say what I said then, which is, you can make all kinds of investments, and you can discharge if you can't pay back the loan, you can discharge it in bankruptcy. The one exception we make is student loans. And I ask whether that is wise national policy. People borrow to invest in their education. That we do not forgive. It seems like something for Congress to consider, that's all. It's none of the Fed's business, really. Ultimately, it's not a big macroeconomic thing, but I've said it before. I said it again.
Mr. Chairman, I appreciate your breaking your own rule before, and I appreciate your
I won't do it again.
Now. I could not agree with you more about the anomaly in the ability to discharge a debt in bankruptcy. The idea that student loan sort of is the one category of debt that we don't allow to be discharged is confounding. I think, unfortunately, so far, it's been a sign of the power of some of the companies involved in that area. And I just came from another committee where I'm the ranking member, so I apologize if you already talked about the tariff situation. But I know this was obviously a factor that you all had to consider in making decisions about changes in the interest rates. Obviously, there's a lot of uncertainty in the economy. I mean, I hear it every day from Marylanders. We have the Port of Baltimore. We have lots of small businesses that rely on tariffs. You're an economist. You know that increasing tariffs is like increasing taxes across the board. But can you just speak to the uncertainty component of all of this and how that is weighing on people's decisions?
So surveys show very widely that people feel uncertain about the economy, and they do point to tariffs in that answer. I will say, though, that actually peaked back in April and has come down a little bit. And if you talk to businesses, I talked to an unusually large number of business people in the last couple of months, and the feeling is a little better now than it was. They're getting on with it and feeling, I'd say surveys are still showing depressed sentiment, but it's moved up from where it was.
I would say, Mr. Chairman, that may be the case at this moment, but we all know that we could wake up any morning and see another tweet, and that could change dramatically. So I appreciate your efforts to try to do what you can to meet your dual objectives at the Fed. Thank you, Mr. Chairman.
Yes, sir. Senator Lummis.
Thank you, Mr. Chairman, and thanks, Chairman Powell, for being here today. As you know, what always vexes me and has for the last 4.5 years about the Federal Reserve is the bank supervision function as opposed to the monetary policy function. So I'm going to focus on bank supervision. First of all, I do want to thank you and Vice Chair Mickey Bowman for ensuring reputation risk has been removed from the bank supervision process. It was very arbitrarily used by those who were supervising. On January 27th, 2023, I'd call it the high watermark for Operation Choke Point 2.0. The Federal Reserve Board, in coordination with President Biden's White House, executed a coordinated attack to isolate the digital asset industry from the banking system. And while the Fed has taken steps to adopt a more balanced approach to digital assets, which I appreciate, the legacy of January 27th, 2023 remains with us today. So I'd like you to look at this quote. It says, issuing tokens on open, public, and/or decentralized networks or similar systems is highly likely to be inconsistent with safe and sound banking practices. So my first question is, do you recognize this quote?
Yes, not super clearly, but yes, I do.
Because it's from the Federal Reserve Board's policy statement on Section 913 of the Federal Reserve Act, which was formally adopted by the board on January 27th, 23. So now, Chairman Powell, I want to show you another statement, and I'm sorry if you can't see it clearly, I'll read it to you. It's from the Genius Act, which just passed the Senate by a vote of 68-30 last week. And it takes the opposite position to the board's policy statement on issuing stablecoins on an open, public, distributed ledger. So my question is, what has changed about the risk of stablecoins since the board adopted its policy in 2023? And now that the Congress has weighed in, at least the Senate has weighed in and sent the Genius Act to the House, does the board plan to withdraw the policy statement on Section 913?
So I think what has changed is, if you go back, that's a couple years ago, that was the period of high-profile failures and fraud and that kind of thing. And what's happened is, I think, the industry is maturing, our understanding of it is improving, and in a sense, it's becoming much more mainstream. So all of us are revisiting, the things that were done during that era. And I think the current view is that, that it's appropriate it's always been appropriate for banks to choose their customers and to be able to undertake activities as long as they're safe and sound. In terms of, I think I have to get back to you on 913. I think it's a broader thing that has nothing to do with crypto, but that was a piece of it. We are looking at and withdrawing many of our pieces of crypto guidance from that era, though, as you know.
And I appreciate that. I hope that by withdrawing the guidance, that you're also instructing and admonishing your bank supervisors to when there are efforts to regulate banks that provide too much discretion to bank regulators to pick winners and losers from among the customer lists, the loan portfolios of banks. It's antithetical to the American system of banking. And I do think that there was that kind of discretion unleashed on banks, and it had a negative impact, a real chilling impact on banks as they selected and banked certain industries and then debanked other industries and other people during the last 4 years. So taking the guidance documents and policy statements out is important, but also guiding the people that there are changes now and that they can no longer use their own subjective biases towards DEI and ESG and other things in supervising the banks is also a critical component of bank regulation.
I agree completely. And as you know, Vice Chair Bowman is actually a former bank supervisor, so she's very well placed to make that happen.
And I realize that she as vice chair is more directly involved in bank supervision. I hope that you will use your role to punctuate the importance of those changes within the bank supervision function at the Fed.
We're going to have to move on.
Thank you.
I'm assuming your answer is yes. Senator Smith.
Thank you, Mr. Chair. Good morning, Chair Powell, and welcome to the committee. So, Chair Powell, a few months ago, you issued a warning about the trajectory of our national debt. Speaking at a New York Times event, you said the U.S. federal budget is on an unsustainable path. The debt is not only at an unsustainable level, but the path is unsustainable, and we know that we have to change that. Would you still agree that that is true?
Yes, that's the one thing that I would always say, and that my predecessors have said, and that's the kind of the only thing we say about fiscal policy.
Exactly. And I would agree with that. At a time when Americans are struggling to figure out how to afford their lives and have low confidence in the economy, to add to the deficit now, as the big, beautiful bill does, just strikes me as unsustainable. Now, I'm not asking you to moderate between Republican and Democratic policy differences on the big, beautiful bill, but would you agree that the big, beautiful bill adds to the deficit based on the data that you've seen?
I'm just not going to comment on the reconciliation.
Okay. Well, I will just point out to my colleagues that the CBO says that it adds to the deficit. The Joint Committee on Taxation says that it adds to the deficit. The Yale Budget Lab says that it adds to the deficit. The Committee for a Responsible Federal Budget says that it adds to the deficit. The Penn-Wharton budget model says that it adds to the deficit. And even some of my Republican colleagues, Senator Johnson, Senator Paul, say that it adds to the budget. And as Senator Johnson says, it's wrong and immoral. So I appreciate that you won't comment on any of this, but let me just ask you an economic question. Can you talk a bit about what impact a rising deficit has on our goal of lowering costs for Americans, especially in the Trump tariff environment that we are in right now?
I'm sorry.
What impact does a rising deficit have on our goal of lowering costs for Americans, particularly when we are in this Trump tariff environment, the unpredictability of that?
So I think it's likely that when markets are pricing longer-term Treasury securities, there's something baked into that in the market's thinking about interest rates. What should be the appropriate interest rate? But it's hard to unpack that with any precision. But
These are factors that have lots of interplay between one another.
yes.
Yes. And Chair Powell, could you just comment briefly about the sort of the potential risks of stagflation, where we have slower growth and higher inflation? I know this is something that the Fed guards against, and could you just comment a bit on the risks of that and what it means for regular Americans trying to afford their lives?
So we're not seeing that now.
Yeah.
It isn't really the base case that that's what we're going to see. But of course, that's a very difficult thing because, a stagnant economy wants more stimulus, but an economy with more inflation wants less stimulus. So
Right.
it puts the central bank in a hard place. We've warned of it, but it's honestly not something that we're facing or that we expect to face. But it's something we're monitoring is what's happening.
Thank you. I want to follow up on a question I asked you the last time you were before the committee. I asked about the impact of severe weather events, otherwise known as climate change, on home insurance costs. And you testified that, I think you said, if you fast forward over 10 or 15 years, there are going to be regions of the country where you can't get a mortgage because of can't get a mortgage because of the impact of the challenges of insurance companies just not being able to provide that. Since February, when I asked you that question, home insurance rates have continued to climb. A recent analysis about climate risk from First Street found that financial burdens from severe weather are driving up household costs and triggering increased mortgage defaults. Now, it's at about 8% now, but they project that by 2035, 30% of all foreclosure losses would be related to climate impacts, which is pretty stunning. Now, I realize this is a complicated issue because insurance is regulated primarily at the state level, though there are exceptions. Flood insurance and terrorism insurance are exceptions. But I wonder if you would comment on this. I'm thinking a lot about what impact this has on housing costs, which is a big component of inflation and a place where housing costs are rising higher than the general inflation rate right now.
Many things are driving up housing costs.
Yes, that's true.
It's of course mortgage rates, but it's also zoning costs and things like this for properties that are near the water. Particularly, for example, we spend some time down in Florida. Property insurance just gets more and more and more expensive, and to the point where it almost makes sense to self-insure, and that's because of just big losses. Companies are just putting that in their models, and they're charging what they need to charge to make a return. And if they can't get that, then they'll leave that state. So that seems to be what's happening.
I know I'm out of time, Mr. Chair. Thank you.
You're always polite. So,
Minnesota knows.
gave her 22 seconds. Yes. Thank
That's
you,
why
ma'am.
they call me the Velvet Hammer, sir.
I didn't say that you weren't harsh as well. You're just nice when you do it, like just right now. See, Senator Moreno remind me not to give Tina a compliment in the middle of the back.
Chairman Powell, just want to make certain I understand this correctly. Control inflation and maximize employment. That's it. Two things, correct?
Yes.
So let's take one at a time. Maximize employment. Do you care if every American makes minimum wage or makes a livable wage? Is that something that factors into your thought process? In other words, we have full employment, but most Americans are on substandard wages. Does that change your calculus?
Does it change my what?
Calculus. Do you care? In other words, is it full employment is full employment? Every American has a job, but they're making minimum wage versus having a family-sustaining wage. Does that matter to the Federal Reserve?
It would matter to the country a lot.
I'm saying, does it matter to the Federal Reserve when you're making your decision?
Honestly, we don't really have the tools to affect that.
Right. So it doesn't factor in. Now that's different than us. The people of this country elect us to make certain that their wages are higher than inflation. And by the way, let the records show that real wages are up this year. So we've done that, not the Federal Reserve. Second piece of it is, let's talk about inflation first.
Well, we've helped control inflation, which is part of that.
We're going to jump right into the inflation conversation. There's different kinds of inflation. There's different causes. There's not witnesses to inflation. There's key actors to inflation. Would you agree?
Sure.
Okay. So let's talk about the actors. Did you comment during COVID lockdowns that that was a bad idea, meaning that you're shutting down the entire economy? It's not a button. I hit the button, you can hear me. It's on and off. COVID wasn't that. We just shut down the economy. Any comments on that?
Of course not.
Okay, so you didn't comment on that. Vaccine mandates, something that my Democrat colleagues loved. If you don't get the vaccine, you're a terrible human being. You can't go to work. In fact, Joe Biden was overruled by the Supreme Court because he said that if you work in a company with more than 100 employees and you don't get vaccinated, the company has the ability to fire you, unless you prove that you're negative on COVID. That obviously is a supply chain shock, wouldn't you agree? If I'm running an assembly line and now I have to put my people 6 feet apart and now I have people quitting or not coming to work or I have to fire them, that's a supply chain shock, wouldn't you agree?
I mean, it's a medical thing that you
No, but it's a supply chain shock.
George Washington.
I'm not asking you to make a medical decision. I'm asking you to make a Fed decision on inflation.
way outside anything we would comment.
But it affects inflation because supply.
It didn't, in fact.
Are you saying that supply chain shocks don't affect inflation?
They do, but that
Okay,
one
they do.
didn't.
So that's clearly one. If you ban the export of liquid natural gas, which is going to cause the commodity price to go up, would that supply shock not also cause inflation?
Potentially could.
Yeah. So, and now the ranking member loves to talk about billionaire corporations, that are going to get away with paying taxes, right? Who pays corporate taxes? Like, who pays it? Is it like some obscure Wizard of Oz character behind the curtain that is a corporate entity that pays taxes? Who pays taxes?
I mean, ultimately, it's shareholders and customers.
So I'm going to read you a line. You tell me this is accurate. On taxes, it's not possible to know in advance precisely how the costs will be shared for taxes. I added
Correct.
that.
I would
But
agree.
it is highly likely that consumers will pay a meaningful share. Meaning if the ranking member has her way, let's just tax corporations at 100%. Why not? Be fantastic, right? No, nobody would want to start a company, but that aside, that cost would be added to consumer products, correct?
A tax or a tariff? What are you talking about now?
If the income tax for American corporations goes up, they will share that tax burden with their consumers. True or false?
Yeah, ultimately.
Yeah. So then taxes do raise inflation, but you don't comment on.
I mean, they haven't,
and
though.
you
It's
don't.
just-
but
that's
you
just
don't.
not true. I mean,
I got
empirically, it's not true.
The chairman's going to beat me up in 56 seconds. So, but you sent me a very nice letter, which I appreciate. And it says the Federal Reserve plays no role in commenting on trade policy. So you don't comment on supply shocks. You don't comment on tax policy, which clearly affects inflation. You don't comment on demand pull. You just said now that we should forgive student debt. Why is a person that goes to Harvard, that gets a gender studies major, pays Harvard obscene amounts of money because professors are grossly overpaid there? Is that person better than a working class Ohioan that is a plumber but can't afford a car because interest rates are too high and car prices have gone up? Why don't we forgive that person's car loan instead of forgiving their student loan? But you don't comment on that. You comment on tariffs. So I'm going to just show you.
I don't comment on tariffs at all, actually. I comment on
only
inflation.
commented on tariffs.
I'm not commenting on the wisdom of tariffs.
Look, the chairman's over there in the conversations. I'm going to show you a chart here. This is car prices.
I'm paying attention, however.
This is car prices since this year.
Come on.
Car prices are down. Car prices are down. Inflation in America is down. We got elected by millions of voters. You got elected by one person. He doesn't want you to be in that job. And you are costing this government $400 billion a year by refusing to lower interest rates. Nobody in this chamber has that kind of power to have a $400 billion impact on this economy, on our deficit. And I just think that you should consider whether you're really looking at this from a fiscal lens or a political lens, because you just don't like tariffs.
Senator Warnock is next.
Thank you, Chair Scott. Thank you, Chair Scott, and thank you, Chair Powell. Good to see you. The United States national debt currently exceeds $36 trillion. Last year, we paid nearly $1 trillion in interest on the debt alone, more than the federal government spent on educating and feeding our children. Chair Powell, how does the Fed consider rising national debt levels during discussions about adjusting interest rates?
We really don't. We take fiscal policy as completely exogenous, and we look at the data that's coming in, but we don't, we're never going to take into account budget deficits and things like that.
Well, here is my concern. Maybe Congress should be thinking about it. The world is losing faith in America's ability to repay our debt. We have seen a sell-off in the bond market. The United States dollar has lost more than 10% of its value against the euro and pound, and is down against nearly every single major currency in the world. Back in May, Moody's downgraded the U.S. government's credit rating because of growing debt and sinking confidence in lawmakers' willingness to address this issue. Historically, high debt pushes up interest rates, slowing economic growth and setting up a dangerous debt cycle where both interest rates and debt continue to rise. Chair Powell, how does the size and the trajectory of the national debt affect the Federal Reserve's ability to manage inflation in good economic times and spur investment and hiring in slower economic times?
I'm happy to say that today, those things do not affect our ability to do our job. The concern really is that if we don't do something, then there will come a time at which it will be a problem, not for us, but for the country. But that, at this time, it does not interfere in any way with our ability to do
that. Is a realistic concern in the future, given the rate of increasing debt. And it's something I'm concerned about, and maybe because it's in the future, maybe that's why, folks who have power, who sit in these jobs, aren't as concerned about it as perhaps the Congress should be. I'm concerned about it as a father of a 6-year-old and an 8-year-old. I'm concerned that my Republican colleagues are planning to ram forward a bill that, according to the Congressional Budget Office, will increase the deficit by $4.2 trillion. So I want us to think about that. We're taking food out of the mouths of hungry children. This bill could cut as many as 16 million Americans off of health care. When we think about Medicaid, 71% of the Medicaid recipients in Georgia are children. So we're taking their health care, and then we're saying to these children that you'll have to deal with these trillions of dollars in debt one day. $4.2 trillion increase. Senate Republicans are trying to use a budget gimmick to claim the bill only costs a fraction of that by simply not counting things they don't want to count. If they don't like the math, they just change the formula. But the markets and those investing in our country don't care about these budget tricks. And I don't think it will help my 6-year-old and my 8-year-old when the bill comes due on this. They know the truth, and they will react based on the truth. The big ugly bill will put the United States on a disastrous fiscal path, and it will be catastrophic for our economy. Even worse, the big ugly bill is cutting people off of their health care, and for what purpose? To give tax cuts to the wealthiest. So this is an interesting moment for me, for someone who didn't know I'd end up in politics, or just paid attention to politics over the years. They're getting ready to create a whole lot of pain for a lot of people. And the question is, for what purpose? To give billionaires a tax cut. I think we ought to work together to prioritize extending tax cuts for the working class. We shouldn't be cutting their health care. We ought to save the country trillions of dollars by not giving more tax breaks to the richest Americans. And if we try to work together, we can save our economy from this disaster and still protect working families from a tax hike. I believe in tax cuts. I think working class Americans ought to give them, ought to receive them. And we ought not be burdening our children with all of this debt. With that, I yield, and the chairman should take note that the Baptist preacher is done with 3 seconds left.
And the people said amen. Okay. Senator Haggerty.
Thank you, Chairman Scott and Ranking Member Warren, for holding this meeting. And Chairman Powell, it's good to see you here again. Chairman Powell, I want to talk with you about inflationary and deflationary trends in our economy and how they impact your thinking. I understand, based on your testimony and recent statements, that you're acutely sensitive to the inflationary risks of our administration's trade policy. And though I note that it's not the Fed's responsibility to attempt to steer or to directly offset that policy in any way, I look at that, I look at your perspective, but I also look at many of the other developments in our country that I think present the opposite risk, which is a disinflation risk. And let me dig into this a bit. We're witnessing artificial intelligence adoption at breakneck speed. That's going to bring about productivity gains in nearly every aspect of our economy. We're about to pass a tax bill. That tax bill is going to encourage capital expenditures and long overdue upgrades to our manufacturing capacity, again, increasing productivity. And if you think about the concerted effort that's being undertaken by our federal government right now to reduce waste and bloated, unproductive government payrolls, all of these point to disinflationary productivity gains. So given the competing sources of uncertainty that we're talking about, it feels to me like the Fed's far more focused on tariffs and the inflationary impact of tariffs than on the deflationary impact of the points I just mentioned. So if uncertainty around tariffs is the primary reason that impacts your thoughts, I mean, how do you counter, how do you bring into account these disinflationary trends that I've just mentioned?
So we do look at the overall picture, and that's actually what's been happening is services inflation's been coming down, and that's been covering what we see so far, small increases in goods inflation. I would also mention a factor that you didn't mention on your list, which is regulation, which is an area which could also be over time disinflationary. Yeah. So we get that. I mean, I try to say that it's the broad sweep of policies and the broader economy that matters for inflation. I get asked about tariffs a lot, and that's the one where all forecasters are expecting, a significant increase between now and the end of this year. We don't know how big it's going to be. We don't know when it's going to come, but it's just something that we're waiting to see more information on so we can make a better decision on interest rates. That's all it is.
Well, I hear the discussion about not knowing the magnitude and the timing of the trade talks and the resulting tariffs that will ensue. It does seem to me that there's a bias toward viewing this as more inflationary than deflationary. And I'd like to ask you this. If Ambassador Greer is successful at bringing the trade deals together soon and alleviating that uncertainty, what would that do to your perspective on rates? Would that put you in a position to think more aggressively about lowering rates?
Yes, potentially it would. I mean, really, it's reducing uncertainty would help, and also just what's going to be the final tariff rate and getting that settled. And I think that's the path we're on.
I think that's welcome news. I think the markets will welcome that as well, because I do believe that we're on the path, as you're about to say, of having some significant resolution in trade uncertainty. We've lived in an unbalanced world for years, where the United States has had the lowest tariff barriers in the world, and other nations have taken advantage of that. Jameson Greer and this team, Scott Bessent and his team, the president, everyone is making a concerted effort to fix this. So I'm looking forward to that. One other area I wanted to touch on, because it's touching close to home, and that is legislation that this committee has just passed out and that we've just passed in the Senate. That's to do with the Genius Act. We just passed it last week. And it provides an urgently needed regulatory framework for payment stablecoins, and it requires that they're backed one-to-one by cash or short-dated U.S. Treasuries. Over the last 5 years, the total value of outstanding stablecoins has increased from approximately $4 billion to over $2 billion today. One market participant has predicted that if a framework like the Genius Act is adopted, total issuance of dollar-pegged stablecoins could reach nearly $4 trillion by the end of the decade. So I wanted to get your perspective again, Mr. Chairman, of what impact would this new source of demand for bills have on the yield curve, and in particular, what impact would it have on short-term rates?
So more demand is going to have a tendency to drive down rates. I don't really have a sense of how big that effect would be, of course. And let me just say that it's a great thing that we're making progress toward a stablecoin framework.
Thank you, Mr. Chairman. I couldn't agree with you more. The direction clearly is that it's going to drive rates down. I think it's very positive for the economy, positive for our cost of borrowing as a nation. And I appreciate your response there, Mr. Chairman. Thank you very much.
Yes, sir. Senator Cortez Masto.
Thank you, Mr. Chairman. Chairman Powell, it's good to see you. Thank you for being here. I want to follow up on a question from Senator Warner about data deterioration. I'm concerned about that as well. that the Trump administration, I'm watching as they've ended dozens of research studies that business and government leaders rely on. So my question to you, are there specific research projects that the Bureau of Labor Statistics provided that they no longer do provide, that the Federal Reserve researchers cannot replicate on their own or through other sources?
I'm not aware of any.
Okay.
That doesn't mean they don't exist, but mainly it's the regular data they supply. And as you know, they've cut back on the size of that survey.
Right. So I would hope as we move forward, and not just in today's hearing, but if there is some other data or you're relying on data that you're not getting, or there's now another source for that data, I would please share that with the committee. Thank you.
Yes.
During the Biden administration, the Federal Housing Finance Agency and the Federal Reserve worked together to improve access to the discount window for banks. What is the status of that collaboration with the FHFA?
I can't speak to the FHFA. I can speak to the fact that we're really looking carefully at modernizing the discount window and making.
But we're not there yet.
It's going to be. This is a project that will take some time. It's the discount window needs to be updated and refreshed from a technological standpoint so that people can access it readily and that kind of thing. It's still a little bit behind the age in that respect.
Do you have a time frame that you're looking at to?
I'll get back to you. It's something we've been working on hard.
Or is there a funding impediment that is also
No.
addressing this?
No.
So, okay,
No.
If you could.
We're moving
provide-
ahead with it. I'll come back to you on
Okay,
that.
thank you. In March, the Federal Reserve, together with the FDIC and OCC, announced that you all intend to repeal the 2023 Community Reinvestment Reinvestment Act proposed rule. I prefer the proposed rule as it would better address the needs of states like Nevada that don't have headquarters of large banks. How will you ensure that the new CRA guidance improves access to financial services, to loans, to investments in underserved rural and tribal communities?
So I think in March we announced that we're putting out for comment really a proposal to withdraw the proposed guidance, which
Okay.
had been the subject of litigation. And in the meantime, we're going back to the old CRA rules, and I think that's where we will be. I don't have anything more in terms of what we might change with respect to those old rules, but that's where
So
we
the
are.
default are the old rules,
Yes.
and those may be.
CRA as it existed before
Ongoing,
this
yeah.
proposal, which actually never took effect.
Right. Okay, that's helpful. Community banks benefited from high deposits during the pandemic. Since then, the net interest margin for community banks has fallen. What specific challenges do you see for community banks, if any?
Community banks, are very important. We want a banking system that has all different sizes and shapes of banks, and community banks are absolutely critical. They know what's going on in communities and in a way that the big banks can't possibly. So they're a critical part of our infrastructure, and I think they've been under pressure because, frankly, regulatory costs fixed costs of regulation have gone up. We try not to contribute to that. The number of banks has been going down pretty steadily. And that's not something we're trying to foster, but it's a sort of long-run trend of really the last 30 years. So we try not to add to what is a secular trend because we think they're important.
Thank you. Thank you for being here. Appreciate it.
Thanks.
Ms. Chairwoman, I yield my time.
Who's up next? Senator Britt.
Thank you very much, Madam Vice Chair. Chair Powell, thank you for being here with us today. I want to start just by echoing the comments of Senator Cortez Masto when it comes to community banks. Obviously believe that community banks and credit unions, financial institutions that serve everyday Americans and main streets across the great state of Alabama and our country are so critically important to people being able to actually achieve the American dream. And want to make sure, I know we've talked about this the last few times that you've been in front of us. We've talked about the rewrite of Basel III. We've talked about long-term debt. We've talked about Reg II. We talked about a ton of things and talked about my concern that no one was looking at the cumulative impact of those things and the trickle-down effect. I just want to get a commitment from you that as you are reviewing rulemaking across the board, that you will consider and make sure to make the perspective of the smallest U.S. banks and non-financial industries like the ag sector who did not maybe have a seat at the table in previous administrations, but give them a seat at the table and make sure that you're thinking about the impact on those individuals and the people they serve.
I'm happy to make that commitment.
Thank you so much, Chair Powell. I also want to talk to you about an issue that has been brought up briefly today by another colleague of mine, but that is about childcare. So when we look at the childcare crisis in this country, we know that our economy loses about $122 billion a year because of affordability and accessibility, reliability, if you will, of childcare. It is said that anyone who has a child between the ages 0 and 5 actually spends 22% of their income on childcare. We have done the studies and looked at the numbers, and 59% of stay-at-home and or part-time working parents say that they would like to re-enter the workforce, but that affordability or accessibility is an impediment to do that. As we are looking to build back America, as we are looking to create opportunity and bring those things into fruition, would you agree that taking a look and being able to address, not asking you to comment on any specific proposal, but addressing some of the shortfalls related to accessibility and affordability of childcare would have a positive long-term impact on the economy?
So I think there's quite a bit of research showing exactly that, and we really saw it during the pandemic. As I think you know and pointed out, it's not an issue that we play a role on, but clearly it would contribute. Childcare would contribute to participation in the labor force by many.
Absolutely. And as Alabama looks, we look at our labor participation rate. It is 5 points lower than the national average. We continue to look to ways to get people re-engaged in the workforce and know that addressing this head on will help us be able to achieve that. So thank you so much, Chair Powell. I look forward to continuing to work to get that done. So there has been some angst vocalized about the reconciliation bill and the president's trade policies. And from my perspective, much of that skepticism is both unfair and premature. Market resiliency and recent economic data actually continues to reflect confidence in the U.S. economy. Look at the recent Treasury auction, which was notably successful and saw stronger than expected demands for 30-year bonds and stable, even slightly declining yields. To me, this demonstrates that investors still view the U.S. debt as an attractive asset, regardless of the ongoing policy discussions and debates and forging a pathway forward. And those fundamentals of the economy, actually remain quite strong. Chair Powell, would you agree that the components of our economy actually remain quite strong? And how does the Fed consider this type of strong auction performance in the context of your market expectations and monetary policy discussions?
So, as you point out, the Treasury market is working fine just now. Liquidity is adequate, and bond prices are responding to economic events, and so bond market's in good shape. In terms of the strength of the economy, I would strongly agree. The labor market's in a solid place. The economy's growing. Inflation is in a pretty good place, come much closer to 2%. So it's a very solid economy. We are watching the labor market very closely, as we always do. And a couple of things in particular. One is just a very low hiring rate, which goes with a low layoff rate. But if we were to start to see layoffs, we would see unemployment go up quickly, and so we're watching that carefully. But the labor market has remained solid, and I would agree with your overall characterization.
Thank you. Appreciate you being here today.
Thank you, ma'am. Senator Kim.
Yeah, thank you, Chairman. Thank you for coming before us today. You've often said in the past that when it comes to monetary policy that it works with a lag, right? That this is something that you're having to try to assess the data that's before you.
Right.
I'm thinking about this because we have the Federal Open Market Committee, FOMC 5-year review, and you were talking about tariffs and the uncertainty of this moment. So I guess I just wanted to ask you, how do you balance sort of assessing between more of the backwards-looking data that you're able to look at more tangibly in that way, but also addressing sort of forward-looking models to try to understand where things are heading?
That's really the challenge that all forecasters have, and really monetary policy needs to be forward-looking. At the same time, we need to be humble about our how hard it is to forecast. So particularly at times of high uncertainty, which I would say I would include now. You really want to look at the real data and take signal from that, and not be too brave about what your forecast might be, because it's going to be highly uncertain.
So you're saying that in times of greater uncertainty, in some ways that makes you more interested in the backwards-looking data to sort of guide you?
Well, I'd almost flip it around. Yes, but I'd almost flip it around and say at a time like that, you don't want to be giving a lot of forward guidance, and you don't want to be acting as though you have a lot of certainty about the path forward. It makes sense to move more slowly in most situations where there's more uncertainty. There are situations where it would not make sense to move slowly, but in most cases, you'd want to move more slowly.
Yeah, that's interesting. I mean, I talked to some of my constituents back home. There's this one conversation I had that has really stuck with me, where, a woman was telling me that, there's so much uncertainty right now in the world and certainly in her life that she says it's hard for her to even breathe sometimes. She just feels this kind of weight upon her chest. And I've thought about that a lot, because I try to think through what can we do to try to alleviate that concern, alleviate that anxiety for people. But you can see it. I mean, right now, whether it's about what's unfolding in the Middle East and the fragility of what comes next. When I look at this reconciliation bill before us in the Senate, I do worry not just about the deficit, as some of my colleagues have mentioned, but about the potential of significant job loss that we're seeing, whether in the healthcare industry, whether in the energy industries. And certainly when it comes to tariffs, as you said, trying to think through what comes next in terms of whether deals are struck and at what levels. Are you taking into account that by sort of an issue-based level, or are you looking at sort of the global instability in terms of the different crises that are out there? Is that factoring into how you're thinking about when we're talking about legislation here? I know you're not going to go into the policy per se, but if there's a potential for significant job disruption, is that something that you're looking into as you're forecasting?
Yes. We obviously pay great attention to global events, and in an effort to understand what's going on in the economy globally, because that does matter for our economy. So we pay close attention to all of those things and track them. Ultimately, though, we're looking at the U.S. economy and what are the fundamental drivers here, and then making a judgment based on all of that. And mainly, this is a big economy, and we're geographically separated from most of the other big economies in the world. So we have a smaller external sector than most of the all the European economies, for example. So we're really looking at the U.S. and what's happening here.
I wanted to ask you, because, in central banks in other countries, including Bank of England and European Central Bank, they've begun modeling the potential macroeconomic effects of artificial intelligence. They're thinking about how they can use AI to be able to do some of the forecasting, to think through what comes next. I guess I wanted to get a sense of what the Federal Reserve is thinking in terms of similar work in the AI space.
We have lots of people doing work on AI, and more than that, even monitoring research that's going on everywhere in the world. And speaking of uncertainty, it's very clear that it has the potential to make really dramatic changes in our economy, in our workplace, in the jobs of workers, in the way companies work, and all of those things. But it honestly, there's a tremendous uncertainty about the timing of that, and what the ultimate consequences will be, and what the medium-term consequences will be.
I was wondering if the Fed is evaluating AI credit models and how that could potentially deepen disparity in credit access or violate fair lending standards. Is that something that you've looked into at this point? And
yes, absolutely.
Is the Fed looking to potentially affirm some industry standards on this?
It's something we've been aware of for a long time. There's a lot of research that's been done. Before generative AI came along, it's also just machine learning and technology generally. There are implicit biases that can appear. It's something we're very well aware of, and we do work with people to make sure that doesn't happen.
Okay, thank you. I yield back.
Thank you. Senator Banks.
Thank you, Mr. Chairman. Chair Powell, can you talk about how our interest rates compare to other first-class countries around the world?
At the higher end.
And how does that affect the United States?
Well, I think that reflects a couple things. One is just that the U.S. economy has outperformed, has been stronger than others. I don't want to pick on any other nations, but many other nations have had much lower growth, now have lower inflation and are, have pretty low growth, whereas the U.S. economy has really been the outstanding performer and remains that to this day. That implies somewhat higher rates.
So you say it's higher than most of first-class countries. Can you talk about historically where we've matched up with other countries?
Yeah, I mean, so let's just go back to when the pandemic hit, for example. We were we had very low rates during that era, but they were by far the highest in the developed world because the U.S. economy was the strongest. The European Union had negative rates. I think the Bank of England was at 75 basis points. I think we were at 2.4%, so we were way higher. And again, it was a time when we were our growth was higher, and their growth was lower, and their inflation was lower. Our inflation was fine, probably about the same as ours. So I think we've generally had a little bit higher rates than those countries because they have slower growth, older populations, lower productivity, those kind of things. We have the strongest economy in the world.
Globally gone up as well?
Sorry?
Have interest rates in those countries globally gone up as well?
Well, they went up.
The U.S.?
All of those countries had their rates go up quite a bit during the global pandemic inflation, right? And as you know, many of them have been cutting their rates, and we had been too, and we'll at some point resume that. But we're 100 basis points lower than we were. I think if you take the EU and the Bank of England, they've both cut a little more than that.
How recently?
Recently, but But I think you probably read this, but they're either at or close to the end of their cutting cycles.
I know there's been a lot of talk today about deficits and the national debt. But how much does tax policy affect the economy in the U.S.?
I mean, it has big effects over time. It's really not something that drives what we do. It isn't. But I think tax policy plays over the long run a huge role in incentivizing investment, which helps growth and things like that. I think it's very, very important over the long run. Certainly more important than monetary policy.
Would a $4 trillion tax increase on middle-class Americans affect the economy?
Now here we're getting into the bill.
I understand. I'm asking how that would affect the economy and according to your data.
I'm trying to not make any direct comments on the bill today, if you'll forgive me. But I take your point.
Okay, I am trying to make a point, but there's got to be data that you sit on somewhere that would suggest that large tax increases would affect the economy, would stall economic growth in the U.S.
You could certainly get that out of a model if you wanted to. I mean, but again, I'm inevitably going to be commenting on the bill, right? If I answer that question, so a lot
of talk today about inflation. You've already agreed that inflation is down from where it was a year ago, and would you say steadily declining?
Has been, yes. I more than agreed to it. I'm very pleased by it.
And all of the experts and so-called experts tell us that tariffs lead to inflation. But you seem to have suggested already that inflation is, if not under control, close to being under control.
So inflation's in a really good place. It is definitely in a good place. And, we have a forecast, and so does, by the way, every other, brand name forecaster in the country, which is very similar to ours, that there will be some inflation from tariffs coming. Not yet, but over the course of the coming months. And I think it's reasonable to expect that because someone has to pay. This is hundreds of billions of dollars of tariffs we're taking in. Some of that's going to fall on the consumer. Not all of it's going to fall on foreign manufacturers. And that's the only insight we have. And we're just kind of wanting to see more data on that before we move.
One final question about data. Our trade deficits with China, the EU, Canada, and Mexico have all significantly dropped recently. What does the data tell us about that?
Well, I think that's
how that would affect inflation.
How it would affect inflation. I don't know that it has implications for inflation, but it obviously reflects the tariffs. I think recently you've seen Chinese imports come down quite a bit.
Thank you. I yield back.
Thanks.
Senator Blunt, Rochester.
Thank you, Mr. Chairman and Ranking Member Warren. Chair Powell, welcome back. Inflation has come down meaningfully from its peak And there are signs of moderation in the broader economy. But prices for rent and other essential services remain high, and the outlook is still uncertain. Wage growth remains strong, but productivity trends are mixed. And demand for places to live is high, but borrowing costs and material shortages are making it harder for builders to keep up, adding to the affordability pressures. And at the same time, while I know this is not something you would say, but at the same time, while our Republican colleagues are pushing for tax cuts for the wealthiest Americans that would expand the deficit, the administration's trade and immigration policies are also introducing uncertainty that may not yet be fully reflected in the economy. For families that I represent, the cost of living remains painfully high. Premature easing could have unintended consequences that undo the progress we've made. Later this year, the Fed will update its monetary policy framework to respond to today's inflationary environment. And after years of supply shocks, housing inflation, and fiscal volatility, I hope you will remain strengthened the Fed's ability to navigate the more uncertain economy. And as you undertake this update, can you talk about how you're adapting the framework to these realities while preserving the Fed's commitment to full employment?
I'd be glad to. So we made changes in the year 2020 to our framework, and those were meant to take on board the special issues that a central bank faces during the era of extremely low interest rates, where rates were never very far from zero. In fact, we just barely got away from zero when we had to cut back to zero. And the feeling was very much that if we had any kind of a shock, we'd be back at zero for years on end again. And that's really not a good thing, because the economy can become very stagnant. So what's happened since then, the big thing is interest rates are back to much more normal levels historically. So our policy rate at 4.3% actually doesn't feel like it's particularly restrictive. So it's, in other words, rates have moved way back up. That means that the effective lower bound is less of a problem. It means that the changes we made in 2020 are less relevant. They're not completely irrelevant. So we're making modifications, which we'll be discussing inside of our committee now in the next meeting and in the next meeting, that will return the forecast more to what it was before the 2020 cycle.
I know we had a chance to talk in the past about my focus on jobs and the economy and labor. And I want to follow up on Senator Kim's questioning, where the focus on the changing technology landscape and with artificial intelligence, generative AI, and just its impact on the economy and labor market. How would you describe AI's impact on the economy so far, and how is the Fed measuring it?
The effects of AI are probably not great at this time, generative AI, and the question is how great will they be, and how big will they be, and how quickly will that happen? And anyone who's been exposed to what AI is capable of has to be pretty stunned by what it's capable of. And this is even the early days too. What the experts tell us is that in 2 years these things that you're doing, that'll be nothing compared to what we can do in 2 years. So I think it has enormous capabilities to make really significant changes in the economy and the labor force. And it can either augment people's productivity, or it can replace people, or it can do a little bit of both. Right. But it's going to be something.
You preempted my question, actually. I saw a recent article, and a CEO of an AI company actually said AI could, quote, wipe out half of all entry-level white-collar jobs and spike unemployment to 10 or 20%. And I think he said in like a matter of a year or two. Do you think this is a reasonable perspective, and how would AI-driven productivity gains or worker displacement affect how the Fed defines full employment?
I don't know whether that's, I'm not the person to say how quickly that will happen. What's happened before with technology is it just seems to take a long